Okay, I think we're there. So we'll start without further ado. My name's Gillian McGill. I am going to be presenting to you today on VAT recovery for independent schools. Now, although that title does reflect independent schools, because that is obviously the topic of the moment, all of the concepts that we're going to talk about today are not specific to independent schools. They apply across all businesses. So these sorts of concepts could be useful for you if you do end up having to do VAT reporting in another sector in the future. So this is our agenda for today. We're going to work through all of these. If you have got any questions, please do put them into the question box. We're trying to make sure that these webinars are as useful for you as they possibly can be. We'll try to answer the questions as we go along, but if we don't have time to get to all of you, we'll make sure that we email you after today's event so that you do get a response to those questions. But as I say, I'll stop every now and then and just have a look at the question box to see if we've got anything else to cover. So, although today we're thinking about costs and how we can recover the VAT on those, it's really important to keep in mind the scope of the tax, especially that we are focusing on whether we have got a business activity. Now, if you tuned into our last webinar, you'll remember that we looked a lot at the income treatments for VAT, and those we're going to put to one side today largely, other than the fact that we need to think always about whether we are acting in a business capacity before we start thinking about VAT. We're focusing on inputs, as I say, and working out the recovery of VAT on costs, but we do need to keep in mind that we're always looking at whether we can wholly attribute costs to taxable outputs. So that is the income that generates you VAT at 20%, 5% or 0%, because if you can link your costs to taxable outputs, you can have all of the VAT back on that cost. If you've got a cost that links wholly to an exempt output, you can't recover the VAT unless you're in the de minimis provisions that we'll talk about later. And if you've got costs that relate wholly to a non-business activity that you're undertaking, you cannot recover the VAT. So first of all, let's have a look at when we've got business and non-business activities and what those terms mean from a VAT perspective. Now, we have had lots of case law on trying to define what a business activity is from a VAT perspective, and they don't necessarily correlate to the common man on the street's view of what a business might be, and they don't even necessarily correlate to what our direct tax colleagues might see as being a business activity. So we are having to put ourselves in a VAT mindset here to work out what is business and what is not business. There's been lots of developments trying to define the concept of business through the courts over recent years, but the current position that we've got, and the HMRC guidance reflects this, is that we have a business activity where we result in the supply of goods or services for consideration, and the supply is made for the purpose of obtaining income therefrom. So note, we're looking to obtain income. That could be in cash or in kind, not necessarily to make a profit. So if you're generating income, even if you're loss making, that is likely to still be a business activity for VAT purposes. So our classic examples will be selling your education services in return for the payment of school fees, or leasing property in return for rent. So then on the flip side, when we're looking at what is a non-business activity, it will be anything that you're doing that doesn't fall within that definition of a business activity. So some examples that we've tried to think about that might be relevant for you who are listening, if you've got any private transactions, so things that you're doing without your school business hat on. So if I decided I was going to sell some items privately, that would not be a business activity. Perhaps more commonly, you might well be undertaking a number of charitable activities that you're going to have to undertake in order to fulfill your charitable objectives, but they're not generating you any income, and those are likely to be non-business activities. Then we have the slightly thorny issue of bursaries. So for a number of years, we've all thought that where you are offering full or nearly full bursaries, so that your education provision was free or almost free, that would be seen as a non-business activity by HM Revenue and Customs. But the latest guidance that we've had from HMRC doesn't really address that point. So for now, we are going to take the view that bursaries offered in whole or nearly whole to cover school fees are not a non-business activity, and you can ignore them for the purposes of calculating your VAT recovery. But we do wait to see how that pans out in the coming months and years. So let's look at a little example then. We might have business activity of receiving income from private school fees. And let's say we've also got free use of a new gym to local residents, which is something that your school might feel it's doing in order to meet charitable objects, or it might just be something that your school does in order to generate goodwill with the local residents in the area. So if we've got a new fitness centre that we've constructed, let's say that we are using it for both the school pupils and also giving some free of charge access to local residents. Now, clearly, that building has got mixed use. It's not entirely business because we've got this free use. So there is some business activity of that in that building and some non-business activity in that building. So we're going to have to find a way to establish how much of the VAT that we incur on that property can be considered as potentially recoverable. So in our little example, we've said we've got residual VAT for this building of £75,000. Okay, so we've incurred VAT of £75,000 on this mixed use asset. We are going to say that the use of that building is only available to pupils 5 days a week, 10 hours a day. So 50 hours of time that that building is opened, it's only used by the pupils. And then at the weekends, let's say we've got 20 hours where only the local residents can use the building free of charge. So an example of how we might establish how much of that £75,000 of VAT we can recover would be to take the 50 hours of business use when we've got pupils using the building and they're paying fees over the total number of hours the building is available for use, 70, which gives us a percentage of 71.43%. We apply that percentage to the VAT that we've incurred, 75,000, and that gives us business VAT of 53,571. And then we take that forward to consider in our partial exemption calculations. So the balance, the £21,429 that we have established is our non-business use of that property, is not recoverable, and that will become therefore an additional cost to the school. Okay, so we used in our little example the hours that the building was available for use. But it's important to note there's no actual prescribed method for calculating your business, non-business VAT proportions. You can use any method at all, provided that it gives a fair and reasonable result. In my experience, HM Revenue and Customs are likely to accept any methodology that you put forward, as long as you're comfortable it gives you a robust filing position and you've got the evidence to back it up. So we could have, for example, in our numbers, instead of using the hours, we could have used head count. So counted a sample for a sample period, how many pupils are coming in and using that building, how many local residents are coming in and using that building, and worked out the proportion that way. The point is that you need to give thought to work out what gives you the best result. And as long as that is a fair and reasonable way of measuring the use of that asset, then that is okay. So you've got some flexibility there. So we've thought about business, non-business, and that's the first thing we're going to do. We're going to work out how much of the VAT we've incurred on costs relates to our business activities and take that forward into our partial exemption calculations. The VAT that we've incurred on non-business activities, we cannot recover. We ignore it now. It doesn't hit your VAT return at all. So we're now just talking about your business activities, which was the vast majority of what you will be doing. We need to remember that we have to understand what we have got that is a taxable sale, so income at 20%, 5% or 0%. What we've got that's income that is VAT exempt. And then we will have some costs that are mixed use or overheads or residual costs. And that is where we undertake our partial exemption calculations. So we're going to have to, first of all, do our attribution of costs. We'll have all of our purchases and we'll have all of the VAT that we've incurred on those purchases. And the very first step we need to undertake is to look at all of those costs and establish whether they can be directly attributed to only making taxable supplies, because we can have all of that VAT back, whether those costs can be attributed to only making exempt supplies, because we cannot have that VAT back, or if there is mixed use of those costs. And if there is mixed use of those costs, then they are going to form our residual or overhead pot. So remember here that as soon as there is any mixed use of a cost, it becomes residual. Now, sometimes that might be beneficial because you don't want to have any costs in exempt attribution, or as few costs in exempt attribution as you possibly can. So if you've got a largely exempt building, but there's a little bit of mixed use in there, brilliant, because you can bring all of those costs into your pot and recover more VAT than you otherwise would be able to. Now, the opposite works too. So have a think about what costs might be borderline in your school. We had an example with one of the schools that we've been working with recently where they had a building that was 95% used as classroom space for children, so taxable. But one of the rooms in that building was occupied by a member of the back office staff, and back office activities are always going to be residual. So that the presence of that person in that building was tainting the VAT treatment of that property. Because of the one room in there being used for mixed use, the entire building becomes residual for the purposes of VAT recovery. So in that particular instance, the school was looking at potentially moving that person out of that building into another property, so that then the entire building will become classroom provision, which is a taxable activity, and therefore all costs that relate to that property become fully recoverable. So have a little think. Are there things that could be done, as long as they work on a practical level for your school, that might improve the VAT recovery of any of those sorts of borderline activities on your site? So we've done our attribution. We've got our fully recoverable costs because they relate to taxable activities. We've got our irrecoverable costs because they relate to exempt activities. And then we've got our pot of residual mixed use costs in the middle. And we need to have a way of working out how much of the VAT on those we can recover. And in the absence of doing anything else, you will be using what's called the partial exemption standard method to calculate your VAT recovery. Now, this is an income-based method, and it's quite a crude proxy for trying to work out how you're actually using those costs, but it's the default way of calculation unless you agree something different with HMRC in writing, and that is not a quick process. So everybody right now is likely to be using the standard method unless you've already been registered for some reason and have a special method agreed. But the vast majority of schools who are newly registered will be using the income-based standard method. So what we're going to do under the standard method is take the value of our taxable supplies in that VAT return period. So remember, that's your income that is subject to 20%, 5% or 0%, and divide that value by the total value of supplies in the period. And that is going to give you, excuse me, a percentage then that you can apply to your residual mixed use VAT on costs. So if we had, for example, £100,000 of taxable business supplies in the period, and we had total business supplies in the period of £170,000, so we've got exempt 70,000 there, our VAT recovery percentage under the standard method would be 58.82%. Now, under the standard method, we have a little bonus in that we can always round up to the next whole number. So we would apply 59% to the VAT that's sitting in our residual mixed use pot. And then that amount, that 59%, can be recovered on your VAT return. So just going to pause for a little moment there because we would be remiss not to mention reverse charges at this point. Now, I appreciate that for the purposes of the work that lots of you have been doing today, trying to work out the liability of your various income streams, you haven't been thinking maybe too much about purchases yet. But you need to make sure that you're identifying any costs that you're incurring on services, so things you cannot touch broadly, that you're buying from a non-UK supplier. So if you're buying something, and it's commonly IT licenses or social media costs, from a business that is established outside of the UK, you need to think about the reverse charge procedure. So what this does is say that the place of supply is where you, as the recipient of that service, is established, so the UK. So it's the UK tax authorities who have the taxing right over that supply. So you need to find a way to make sure that you pay over VAT as though you had supplied that item to yourself at the appropriate UK VAT rate, and then consider whether you can recover that amount as input tax. So let's have a look at a couple of examples just to put some flesh on the bones there. Let's say you have purchased a subscription from an overseas business to buy software that's used for the children in their learning. So that is going to be something that relates to your taxable income because your school fees are taxable for education. So the cost of that subscription is £100. So you're always going to convert to UK sterling, even if the invoice is not in UK sterling. The cost of that subscription is £100. The UK VAT that would be applied to that, if it had been supplied by a UK business, would be at 20%, so £20. What will go into your VAT return will be output VAT of £20 as though you had sold that license. Then you're going to include £20 in your box 4, which is your recovering position. So that nets out to nil. And you're going to report the £100 as both a sale in box 6 and a purchase in box 7. So the net effect is that nothing is paid over to HM Revenue and Customs because it's purely in and an out, okay? What happens though if what you're buying is not fully recoverable because it's got mixed use and has to be treated as a residual cost for your school? So in this instance, let's say we have purchased a subscription from an overseas provider for, say, a Microsoft Office license that's going to be used across the entire business. And we've worked out that the taxable income over total income gives a residual recovery rate of 94% for this return period. So we still have a subscription cost of £100. We calculate the VAT on the outputs, so the income, at 20%, as though we were the business selling that license. And then we have to think, how much of that £20 can we recover? Just like you would do had you bought this license from a UK business. And in this instance, we're saying we can recover 94% of £20. So we're going to recover £18.80. So the VAT return reporting will be £20 in box 1 as output tax. The £18.80 that we've calculated we can recover because it's a mixed use item in box 4. And then we report the sale and the purchase of £100 in boxes 6 and 7. So the upshot here is that the Exchequer benefits to the tune of £1.20 as compared to if we were able to recover all of the VAT. So all that we've done is put your school in the same position that you would be in had you bought that IT license from a UK supplier rather than a non-UK supplier. A few more bits to think about when we're talking about partial exemption. First of all, the de minimis. Now, I mentioned way back at the start that you cannot recover the VAT on your costs which are attributed to making wholly exempt supplies, so nursery, for example. In addition to which, when we've done our partial exemption residual calculations and we've worked out how much of our residual mixed use costs we can recover, there'll be an amount that's left that we can't recover because it relates to the exempt activities of the school. And that amount, together with the amount that we've said is wholly attributable to making exempt sales, can't be recovered unless it's within the de minimis rules. Now, to be within the de minimis rules, we're talking about pretty small amounts of VAT here. £620 per month on average for that lump of exempt input tax, which equates to £7,500 for a year. But also, it cannot be more than half of the total VAT that you have incurred for that VAT return period. So I think it's unlikely that you're going to fall within the de minimis rules, but it's definitely worth checking because you should be applying the de minimis rules every time you prepare your VAT return. And if you're going to use our standard method template, that does have a section at the bottom which will do the de minimis check for you every time you're preparing a VAT return. Because if you're within the de minimis rules, you can have all of your VAT back. So it is beneficial if you can get within them. But as I say, I think it's unlikely for the majority of schools. So you're going to do your partial exemption every quarter when you do your VAT return. And then once a year, you're going to perform your annual adjustment. And that comes at the end of your partial exemption VAT year, which will always fall on March, April or May, depending on which pattern you submit VAT returns for. And then you do your annual adjustment by looking back over all of the VAT returns in that VAT year and reworking them to check whether you've over-recovered or under-recovered VAT. And if there is an adjustment to make, you report that in either that VAT return for the last quarter of your VAT year, or more likely in the first return of your next VAT year, so June, July, August return. We have been recommending that you all make a request to HMRC on the email address shown on screen to ask for a non-standard VAT year. So you're going to ask to tie in your VAT year to your financial year end, so July or August. So by doing that, you're going to make your VAT return reporting much more straightforward, but it will also mean that your annual adjustment gets performed to either July or August, depending on which stagger you're on. And then you're going to report any adjustment that there is arising from that in either your July or August return or your October, November return. Now, I would recommend that you undertake your annual adjustment calculation and report it in the first return of the next VAT year, because you've got enough going on at year end without trying to work out your annual adjustment position as well. And finally on this slide, once we're up and running and we've done a year's worth of VAT returns, you are able to start using what's called the in-year provisional recovery rate. So what that does is remove the administration from you of having to do your partial exemption calculations every single quarter. And instead, you can look back at last year's annual adjustment percentage and just use that for the VAT returns for the next year, until you then come to do your annual adjustment for that year and arrive at the corrected position. So it removes the administration of doing your partial exemption every single time for you. However, if your recovery rate fluctuates a lot, you may end up with an unpleasant surprise at the end of the year if you've been using the previous year's recovery rate. So that's only really beneficial to you if you've got a fairly stable residual recovery rate in your school, because otherwise you're going to have problems with trying to budget and also potentially a nasty VAT payment to HMRC due at the end of the following year. Other things to think about on partial exemption that we do need to mention: there are certain items of expenditure where the VAT is just blocked from recovery due to either legislative provision or case law. The two most common ones that we put on the screen here are, firstly, if you are buying cars that are available for your employees or trustees to use to any extent to personal use. They don't actually have to make personal use, but if it's available for personal use, the purchase VAT on those items is just not recoverable. It's blocked from recovery entirely. However, if you lease cars, even if there is some private use or available for private use, you're potentially able to recover 50% of the VAT on your lease cost. So that's worth bearing in mind for some planning if cars are something that your school does provide. Then if we've got any business entertaining, we cannot recover the VAT at all. And business entertaining includes entertaining customers, so your current families, potential customers, so families perhaps who are looking around the school, suppliers or potential suppliers. So if you've got VAT that you're being incurring on any of those sorts of items, you cannot recover it. And you need to have a way of making sure that you're picking those items out so they are not going through your VAT return as recoverable. You are able, though, to recover VAT that you incur on costs for employee entertaining. So again, you need to find a way of making sure you've got coding in place so that you can pick out the blocked VAT recovery items as compared to those where you can recover the VAT. And then also having a way of making sure that what gets coded to those cost centres is accurate. We said earlier on that when you're doing your standard method income-based calculations for partial exemption recovery of your residual costs, you round up to the next whole number. Now, I should have said there is a caveat to that. You aren't able to use that rounding up to the next whole number provision if you have incurred more than £400,000 of residual, so mixed use, input VAT in a month on average. So if you're in that kind of level of spend, 400,000 of residual input tax per month on average, then you don't round up to the next whole number, you just go to 2 decimal places. So if you're talking about numbers that big, it will make a bit of a difference in your VAT recovery position. So for newly registered businesses, which most schools will be, you can actually apply the partial exemption rules on an intention basis. So let's say you registered for some reason on the 1st of October 2024, at which point in time you won't have had very much, if any, taxable income at all because school fees were still exempt at that point in time. So if you apply the partial exemption standard method, you won't have a very big VAT recovery at all because, of course, there won't be much taxable income in the top line as compared to taxable and exempt in the bottom line. So in those scenarios, for your first year, what you can do is work out your partial exemption recovery on what your intention is. So if you were intending to have taxable income arising from that cost, then you can still recover the VAT. Finally, on partial exemption, if you have got VAT that you've incurred, and let's say you've recovered all of it because you think you're going to use those costs for wholly taxable activities, but then for some reason your intention changes, if that change of intention happens within a 6-year period, you're going to have to repay the VAT to HM Revenue and Customs. So it works the other way around as well. If you haven't recovered VAT because you thought you weren't going to have any taxable use of those costs, and then your intention changes to making wholly taxable supplies of that cost, then you can have all of that VAT back within a period of 6 years from the change of intention. So something just to bear in mind, particularly for capital expenditure or maybe for new business ventures that your school is contemplating. Finally, on partial exemption, what about surplus property? So this is a question that has been coming up quite a lot with the schools that we're working with. So you've got often large sites, you may well have a building that you're no longer actually using and is sitting perhaps empty or just being used for your own storage for the time being. If you haven't actually got a plan for what you're going to use that building for, then any VAT on costs relating to that property will be falling into your residual mixed use pot. If you then decide to maybe let the property out or take steps to put it on the market for sale, that will then be evidence that you have formed an intention, and that intention will be to make exempt supplies of that property. The reason for that is that generally supplies of property are exempt for VAT purposes unless you have notified an options tax on that property. If you're going to opt to tax the property, then yes, that's evidence that you have got a taxable intention for what you're going to use that property for, and you can recover VAT. But if you've only made that notification quite late in the day, you aren't able to go back and recover the VAT for the period of time when you had not notified an options tax and therefore by default are assumed to have an exempt use intention for that building. So again, something to be thinking about and speaking to your advisors about. If you have got property that's sitting disused, what might you do with that in the future, and do you want to opt to tax it now? Okay, so we've done our business non-business calculation. We've worked out how much VAT we can't recover because it's non-business, and then how much of our business input tax is going to come into our partial exemption calculations. We've attributed our costs between taxable, fully recoverable, exempt, not recoverable, and residual, mixed use. And we've done our partial exemption standard method calculations using taxable income over taxable plus exempt income to give us a percentage that we can recover. Is that it? Sadly not, because the last thing we need to be thinking about is the standard method override. This is an anti-avoidance or anti-abuse mechanism that will apply because that crude mechanism of using income as a proxy for establishing how much taxable use there is of cost doesn't always reflect the actual use of an item. If you fall into the standard method override, you do the calculations that we're going to talk through in a moment, you then report that standard method override adjustment along with your annual adjustment. So in the last VAT return of your VAT year, or more likely in the first VAT return of the following year. So let's look at a little example. Our standard method calculation based on income gives us a 90% residual recovery rate. But perhaps 30% of our pupils are actually receiving exempt education, maybe because they paid fees in advance prior to the 29th of July 2024, so that's exempt income. We might need to think about the standard method override in that scenario. We do the calculations that we'll talk about in a moment, and then an adjustment under the standard method override will be required where the calculations give us a significant difference. And significant is defined here as either a difference of £50,000 or a difference of 50% of the residual VAT in your pot that was incurred and at least £25,000. So let's put some numbers to that to help bring it to life a bit. We're doing our annual adjustment for the VAT year to the 31st of August 2026. So we must have emailed HMRC and asked them for a non-standard VAT year because we're doing our annual adjustment to August. In that year, we have got taxable income of £1.5 million and exempt income of £75,000. We've also had fees in advance received of £550,000, and that was received before the 29th of July 2024, so we're confident that that's exempt. If we use the standard method, we will just be taking our taxable income of £1,500 over our taxable plus exempt income of £1,575,000, and that will give us a residual recovery rate of 96% once we've rounded. If we look at the actual use basis though, what we might do is instead take our taxable income of £1,500 over our taxable plus exempt plus the fees in advance. So that gives us £2,125,000. And in that scenario, we've then got a residual recovery rate of 70.58%. So we can see that there is a significant difference between the percentage recovery rates. We apply that percentage recovery rate that we've calculated to our residual mixed use VAT, and that gives us how much VAT we can recover under the standard method of 706,000 and how much we can recover under our standard method override of 519,000. So we compare those two numbers and we have to work out, is the difference between those two significant under the SMO rules? And here, yes, it is, because the difference of 187,000 is more than £50,000. and therefore we can only recover the 519,000 and not the 706,000. So when do you need to worry about the standard method override? In theory, you should be looking at this every year when you do your annual adjustment. There are certain scenarios, though, when it's more likely that you're going to trip into the standard method override than others. So some examples there. Costs that are incurred in one year, but they don't actually result in any income until a later year. That might well be distortive if you're using an income-based method. Or maybe costs that you've incurred on an intended supply, but that supply never comes to fruition. So you've got costs, but no income ever comes to light. Again, that may well be distortive if you're using the standard method income basis. And then you're going to have to think about using the standard method override calculations to see if you've got that significant difference. So in our little example, we use the fees in advance as a methodology for working out what the standard method override calculations would give us as a recovery percentage. But again, there's no set basis for how you calculate the comparative under the standard method override. You could use any method at all that you think fairly reflects the use of your costs. So that could be, for example, student headcount. If you find that when you're doing your annual adjustment and you're looking at your standard method override, you are regularly having to make an adjustment for the SMO because you're tripping into that substantial difference, that is a strong indication that you need to agree a partial exemption special method with HM Revenue and Customs, because the standard method is just breaking down for you and not really working. Okie dokie. So that standard method override, we're at the sort of higher level of VAT there. If we bring it back a bit more to something that's slightly more comfortable, pre-registration input VAT. Now, we talked about this in our last webinar because it's really important that you take the time now to identify what pre-registration input VAT you can recover, because that needs to go onto your first VAT return. So remember that for services, so broadly things you can't touch, you look back 6 months from the date that you were VAT registered. With goods, things you can touch, you can go back 4 years from your effective date of registration. Now, at the moment, HMRC has not indicated that there's any apportionment required whatsoever for pre-registration input VAT on services. So you can reclaim all of those costs from the last 6 months before your VAT registration date if they relate to your taxable supplies and are going to relate to the ongoing business. Goods, though, HMRC has said they expect to be apportioned based on an useful economic life of 5 years. So we might have, for example, we're looking at goods, input VAT that we've incurred of £10,000. We bought that item on the 1st of January 2024. Our effective date of registration is the 1st of December 2024. So we work out how many months did we have that item where we were making exempt supplies, 10 months being from 1st of January to 1st of December. And then how many months have we got left of its useful economic life? So that's 50 more months, giving you the 60 months or 5 years of economic life. And then you can recover that proportion of the VAT on those goods as pre-registration input VAT. So in this instance, of that £10,000, we can recover £8,333. Remember that you need to know the invoice date or tax point for your purchases, though, in order to make sure that they're within that 6 months or 4 years, depending on whether they're services or goods. With goods, you need to make sure you still actually own those items at the time that you VAT register in order to be able to claim the VAT on them. And you also might need to do a little apportionment if you've used some or not all of an item, and we've got a little example of that on screen for you. Okay, so moving on to the capital goods scheme, which is the big brother of partial exemption. This kicks in where you have got expenditure of £250,000 net of VAT or more, plus, and you've incurred VAT on it, on land or buildings, or £50,000 net plus VAT on computer equipment, aircraft, ships, boats, and other vessels. So by far and away, the most common scenarios that we see are the 250,000 on land or buildings. And that could be buying a property or land, building, refurbishing, extending, converting, all of those sorts of projects valid and count for the capital goods scheme. When we're looking at the £50,000, I would just note, though, that the reference to computer equipment is talking about one big piece of hardware. It's not talking about 50 laptops added together to get to £50,000. We're just looking at one large IT item. So the only time I've ever actually seen that in practice was in a business scenario where they were buying a new switchboard for use in a call centre. That's the only time I've seen it. So I'd be surprised if you have computer equipment that breaches that £50,000 limit. So when you've got those items, what you do is make your initial VAT recovery based on how you're going to first use them. So if you're using that land or property entirely for making taxable supplies, you recover all of the VAT like you normally would. If it's going to be used for entirely exempt supplies, you don't recover any of the VAT like you normally would. If it's going to have mixed use, then you recover at your residual recovery rate. And that goes in your VAT return at the time you incur those costs, just like normal. But then you're going to have to review the use of that capital goods scheme item for a period of time. So for land and buildings, we're going to review 1/10 of the input VAT that you've incurred every year for 10 years. For the other sorts of capital goods scheme items, we're going to review 1/5 of the input VAT that you've incurred every year for the next 5 years. And during that period of review, 10 years or 5 years, if your level of taxable use has increased or decreased, you're going to make an adjustment, and that adjustment to the VAT position is going to be reported in the second return after your VAT year end. So the return after we're saying you do your annual adjustment in. So let's have a little look at an example. So here we've got a mixed use property, so it's residual for VAT purposes, and that property was bought way back before we were VAT registered. So obviously at that point in time, the VAT that was incurred by the school of £80,000 was not recoverable. So we've got a number of years within our capital goods scheme 10-year life when there was 0% recovery of this £80,000. But then we VAT registered. So in the year ended 31st of August 2025, our VAT year ended August 2025, we've worked out that the residual recovery rate for this school is 79%. And because there's mixed use in this property, it's got to be treated as residual, and therefore we can recover 79% of 1/10 of the VAT we originally incurred on that building, which is £6,320 here. And that additional VAT recovery gets reported in the second VAT return after the August VAT year end. And you can see from the example on screen that as the VAT residual recovery rate fluctuates, the amount that we're going to recover under the capital goods scheme also fluctuates. We're always comparing back to 1/10 of the original VAT that we incurred, but the amount that we're actually going to claim back from HMRC is going to be fluctuating as our residual recovery rate fluctuates. And of course, we need to keep in mind here that if we've tripped standard method override, that will be what drives the recovery rate for the purposes of this capital goods scheme item. So what about a new building? So one that you have bought or constructed after you've been VAT registered. So let's say here we've incurred £120,000 on a new mixed use building. Again, we're going to be able to recover the VAT at our residual recovery rate because there is mixed use of that property. And in this scenario, we've calculated that recovery rate at 92%. So we incur the £120,000 of VAT in our year ended 31 August 2025. We can recover 92% of that. So we're going to claim £110,000 back from HMRC. And then for the next 10 years of our capital goods scheme life, at the end of the VAT year in August every year, we're going to stop and we're going to review how that property is being used. And if it's still mixed use, we're then going to apply that year's residual recovery rate to 1/10 of the VAT we originally incurred. So you can see in our example that our residual recovery rate has decreased from 92% to 91%, so a drop of 1% between 25 and 26. So we're then going to take 1/10 of the £120,000 we incurred on this item, and we're going to say, look, we've over recovered by 1%. We're going to pay back £120 to HMRC. So that £120 adjustment will go into the VAT return 2 more after the August year end. And then if the residual recovery rate increases, as we've shown in later years, to say 96%, we're going to claim a bit more VAT back. So that's how the capital goods scheme works. Again, we have a standard template that we can provide to you for you to complete and use. If that is helpful to you, let us know. Okay. Right, we've got a question that's popped up on capital goods scheme. On buildings, is it 10 years from the date of invoice or 10 years from the date? It's 10 years from the date the building is first brought into use. That's when your capital goods scheme clock starts running. So, I mean, it's a fair point. If you're constructing property particularly, you might well be incurring costs for a number of years before the building is actually completed and brought into use. But it's the VAT year when it becomes first available for use that starts the capital goods scheme clock ticking. And that's when you need to start doing your reviews of how much VAT you've recovered over the periods. Okay. So we're nearing the end now. Our final points just for you to take away as a sort of a bit of an aid memoir when you're considering VAT recovery of costs. First of all, always check that the purchase invoice that you have received is a valid VAT invoice, because that is your prima facie evidence for recovering that VAT. Importantly, requests for payments or pro formas are not valid VAT invoices. And also, if you get an invoice from somebody who is themselves not VAT registered, they should not be charging you VAT, and that VAT, that is not actually VAT, you cannot recover it. Make sure that you're using Making Tax digital compliant software. So I would expect the vast majority of schools will need to be using Excel spreadsheets or similar in order to calculate their business, non-business and partial exemption values for the purposes of their VAT return. You need to make sure you've got digital links between the return workings and the boxes 1 to 9 values that you're then going to submit to HMRC. And that will make sure that you're operating in a Making Tax digital compliant way for VAT. Your VAT returns are due 1 month and 7 days after the period end. So they've got to be with HMRC by that point in time. You also need to make payment, and that payment needs to have reached HMRC by that month and 7 days later point in time. If you set up a direct debit, and I would recommend that's what you do, HMRC will automatically take any payment due from you. And just be aware that they don't normally pull those direct debit payments until around the 10th day. So don't panic if you don't see the money going out on day 7. They pull them normally around the 10th, provided your direct debit's set up properly. You're going to calculate your VAT recovery position every quarter using your business, non-business and partial exemption calculations, unless you choose to start using the in-year recovery rate once you get past the first year. And then you're going to do your annual adjustment. And I would say do that in the first quarter of the next VAT year. Give yourself a little bit of breathing space to do that. Then you're going to do in the next return, so 2 after your VAT year end, your capital goods scheme adjustments. Keep your VAT records for 6 years so that they're available for HMRC should they come and want to look at them. You can keep them electronically or in hard copy, whichever you prefer, as long as they're able to be provided to HMRC. Watch out for reverse charges if you're buying in services from overseas suppliers. Make sure that you're scrutinising those purchases, not just looking at income. And again, we've said this before, repeat it now, really do consider getting tax inquiry protection cover, because it's very likely, I think, that HM Revenue Customs will be looking at schools' VAT returns in the coming months and years. But as always, ask questions, get in touch with us. You've got my contact details at the start of this slide pack. That will all be emailed out to you after today's webinar. And you will also be able to contact us via the inquiry@larkingowan.co.uk email address shown on the page. There's lots and lots of content specific to independent schools on the Larkin Gowan website, so do take a look at all of that. There might well be some reference material there that's useful for you, and those will all be emailed out to you after today's webinar. They will also all be uploaded onto the Larkin Gowan website, so you will be able to refer back to all of this at your leisure. I think that is it for today. Thank you all very much for your time and attention. Get in touch with us if there's anything that we can help you with, and have a great rest of your day. Thank you.